Ishaku Ibrahim, go ahead.
Yes, sir. Yes, sir. That's note to the account, sir. There's note to the account.
Note to the account. Thank you so much. So those are the
Hello, sir.
components. Please remember, element is different from the component. The element of financial statement, they are also 5. You have your assets, liabilities, equity, income, and expenses. These are the elements of the financial statement. The components of financial statement are the statement of financial position, the statement of profit or loss and other comprehensive income, your statement of changes in equity, statement of cash flow, statement of policy, also known as notes to the account. Those are the 5 components. Please don't forget, I'm the one that is begging you now. For Michael and Isiaku, they have tried, so I'm giving them one mark. Each and make clap for them. At least it's still very much in their medulla oblongata. Uh, so that's that for that. So quickly, let's run through. We have been able to look at statement of financial position statement of a profit or loss the last class. So we mirror down to looking at statement of a financial position, statement of changes in equity, and then we take a comprehensive income that will also make us to look at a profit or loss, financial position, and the statement of changes in equity as a refresher, and then we conclude the class. So please, this particular standard, I want to believe, may also return, at least in the last 2-3 days, I have been setting cash flow, but I'm particularly thinking that this day they might return back to this publish account. They call it publish account. That is your what is it called? Account for a single entity. So please read solve questions. Not only the 1 or 2 questions that we do in the class that will make you to pass, is the volume, the numbers of questions that you solve every now and then. So please, let's quickly run through what exactly is a financial position. When the system of financial position is just as the name sound, financial position. What is the financial position of the entity? Why that statement of profit or loss measures the performance. The statement of financial position tell us exactly what is the position of the entity, the standing of an entity at a specific date, usually the financial year end of an entity. What is their position? You understand? So it reflects what exactly an entity is having as an asset, what exactly are the liability of an asset, what exactly are the equity of an asset. So when we say what exactly, when we say asset, liability, and equity, we are talking about the fact that what exactly are the stuffs or the things, the assets, so to say, that an entity has. What do they own? You understand? In summary, what do they own? What do they hold? Do you understand? And then what exactly is remaining for the owners of the business, known as equity? You understand? So what do they hold? What exactly do they hold? And what is left for the owners? So that is exactly what a statement of financial position is. So it is a fact and a figure sheet that gives users of financial statement exactly the position, the true position, the views of an entity. That is that for that. So please understand that both IAS 1 and IFRS 18, they did not change anything much. IAS 1 remains the same way as IFRS 18 is under your statement of financial position. Whereas your statement of changes in equity talks about what are the changes that occurs in the owner's contribution in the business from the beginning to the end. And at the end. So you are comparing exactly what transpired, what are the changes that occur from the opening balance of equity. In other words, opening balance of the contribution of the owners to the business at the beginning of a financial period, and then what happened at the end of the financial period. So it's as simple as this. All that you need to know is to understand this basic, and then it helps you to to be handy with information. Whoever is asking you anything, you can easily answer them as professional that you are, because the essence of why you are also in class is to be able to help those people that are not inclined out there if they ask 1 or 2 questions. That is that for that. So quickly, let's run through what exactly are the stuff that makes up the statement of financial position. There are 3 major elements, like I mentioned. We have the assets, we have the liability, and then the equity. So the major component of the asset are the non-current assets. The non-current assets, you know what they are now. They are assets that are expected to be alive in the business for more than one financial year. In other words, they're expected to, to be turned over continually more than one accounting or financial year. While the current asset, they are expected to be turned over or traded within a financial year. So you have one that is more than one financial year. The other one is within the financial year. So the non-current assets are the one that are more than one financial year. The current assets are the one that are within a financial year. When in terms of the way you turn them over, when we say turnover, the way you are using them, the way you are trading them as it were. And so non-current assets can also be divided into what we call the tangible and the intangible non-current assets. Tangible means you can touch it, you can see it. Intangible means you cannot see it. So we have under the non-current asset, we have the PPE, you have intangible assets. Intangible asset like we have dealt with it in IAS 38. I saw some person posting that we don't have the video. I will check my folder. I think we did a recording on that. If it's not there, I will make sure that I do a video and I will send it across. Also for IAS 16, some people also said so. I will check through. If it's not in the folder, I promise you I will do a video and I will send it across to you. And apologies that it's actually still not there. So that is that for that. So we have the PPE, intangible assets, investment. This investment is a investment usually maybe in subsidiary as well as investment properties. So please take note of that. Investment, because these are key things that you also know. Investment can be investment in subsidiary, joint ventures, other businesses as it were that you can and that you have to put in your book so that people will know, or investment property. We deal with investment property under IAS 40. Please get to read and know some of these standards. Then the current assets deal majorly with inventory, receivable, cash and cash equivalents. Prepayments is also here when you pay in advance. For instance, your rent is you're supposed to pay for 1 year. Instead of paying for 1 year, you pay for 1.5 years. You have to recognize that advance payment that you make, and then it's under the current asset. Equally, there is also what we call right of use of assets under this non-current assets. We have done that in IFRS 16, and then it also comes under here. So you can as well have under the current asset, you can as well have what we call deferred tax assets. We have done that under IAS 12 also. So I'm just remembering all of these and to keep you handy with information. Okay. Jade Shola Adeyemo, you're asking a question. I barely can see that. Okay, you cannot hear me. Can you hear me?
Yes, sir.
Okay, Jade Shola, you are saying my audio is what? Please, if you can hear me, let me just have a thumbs up. If someone is saying they can barely hear me, I wouldn't know.
We can hear you, okay.
We can hear you clearly.
So thank you so much. So please, let's go ahead. Maybe it's the network of the individual. So that's that for that. So the equation is asset will always equal liability and equity. Please always take note of that. Asset will always equal liability and equity, and this is why we call it a balance sheet. But they said the name that we call it before balance sheet is archaic, so we should change it and modernize it. That's why they are calling this of financial position. In other words, it means that your asset is equal to your liability and your equity, what you are owing and what you own. So what you own as an asset must be equal to what you owe minus the contributions of the owner. So under liability, we have non-current liability, current liability. Then under equity, we have share capital, share premium, retained earnings, and then other reserves. I'm sure you know all of these nomenclature. Share capital is the contribution of the owner. Share premium is the excess on the contributions. Retained earnings, they are the earnings, the profit after tax that you retained in the business. Then reserves are the other, valuations, if there are revaluation gains and the surpluses and the like. So these are what you have under that equity. So quickly, let's run through what we have under statement of changes in equity. Before we do go, any questions so far on that? Any question? Okay, so if there are no questions, please just understand that's just everything that you need to know for statement of financial position, a lot of changes in equity. So statement of financial position talks about when the entity owns, why statement of changes in equity talks about the changes that occur during the year from uh, the opening value of the owner's contributions and the closing value of the owner's contribution. So it's as simple as this. Very, very simple a component to thrive. Now, let me say this, like I will always tell students, passing your exam is all about strategy. The first thing that you need to know is this. Under your senior financial position, always know that there is asset, there is liability, and there is equity. Very, very important. And you have two sections under your senior financial position. You have the asset section and you have the equity and liability section. The asset section, whatever you have there, must be equal. That's the totals you have under asset must be equal to that of liability and equity. But for exam's sake, please note, it is very, very possible, and I have a question that we may look at in this class. It is very, very possible that you will treat your questions in exam and you are not balanced. Please don't say you want to balance. If you are even balanced, you will be a suspect. We will suspect you that you have cheated. As the truth, I will tell you for a fact. Because even in real life situation, in real life accounting, preparation and presentation, so many times we may not be balanced. And then we throw it to the suspense account, which is not allowed in practice as it were. So please note that. I'm saying this now to enlighten you. Just follow the steps. The ones you know, put it there. The ones you don't know, leave it and move ahead because you don't have time. You have just 3 hours to put down whatever it is that you know. You understand? Under how many chapters? I mean, you have close to how many standards that you have to look at? Close to about 30 standards that you have to be handy with. And then you have to be tested in that 30 standard in 3 hours. Is it possible for you to do well? So if you are under exam conditions, please try your best. That's why we don't say you should answer the question. We say you should attempt. Because by attempting, we know if you are on track or if you are not on track. Please take note of that. Just by the way, let me just put that for you. Please note what I have just said. So for asset, always know that you have non-current asset first, then follow with current asset. Then for equity follows. You now have equity and liability section. Equity start first, then you end up with liability. Under liability, you have the non-current liability, and then which is also known as long-term liability, and then you have the short-term liability, which is also known as current liability. I'm begging you now, just follow what I have the way I've explained now. That's how you should follow it, even in exam conditions. So that is that for that. So quickly, let's run through the format. I put down the format so that you will know to buttress what I have explained so far. So under the asset, you have the non-current asset, like I have said. So you have the plant, the property, plant, and equipment. This property, plant, and equipment is treated under IAS 16. And so we talked about aggregation. I was saying something about aggregation under FR-IAS 18. An aggregation simply means gathering all the like items together so you won't model up the financial statement. So now when you are doing your aggregation according to IFRS 18, you must state it under the notes. So there must always be a column for notes to account in your financial statements. Please take note of that, especially your statement of profit or loss, as well as the statement of financial position. You must always send us the notes. So always know that if you are giving items under non-current asset, like they give you land separate, building separate, vehicle separate, plant separate, what other thing again? Any of the assets, the non-current asset, you are allowed to aggregate them, put them together as a line item. So put them together, group them together, and that's what we call aggregation. Under IFRS 16, this is well strengthened. So you understand that. So that's where you have IAS 16 PPE. We did it in our class. If you're in the class, you understand how to do it. It's very cheap. It's very simple. Just follow the table. You can follow the table the way we put it. Cost, and then less cost. If there are the accumulated addition in the year, you had it. If there are disposal, you less it. Then you have the net cost, as it were, and then you less the depreciation from it. When you less, you're going to have a column for cost, and then under that cost, you have initial cost. If there are addition during the year, you had it. If there are disposal, you less it, and then like that. Then you now come to there are revaluation. Please take note of there are revaluation. You also had it. Now you now come to the second section, which is depreciation. Under the depreciation, your accumulated depreciation, which is also the opening depreciation for the year. They may not tell you accumulated depreciation. They may say depreciation 1st of January. Once you see it that way, you should know that it's an accumulated depreciation. You understand now? So you take that down, and then the depreciation for the year, you add it to it. The total, I used to separate it. I call the cost section A, and I call the depreciation section B. So A minus B will give you what we call the net book value of the asset. So the total that you have at the extreme end, the total for all of these grouped assets together, is what we call the PPE value that you take to your statement of financial position. The same thing is applicable to intangible assets. All the intangible assets that may be in your question, put them together, aggregate them. That's what we call aggregation. Put them together as well. The way you did in your IAS 16 is the same way you will do aggregation for intangible asset if you have all of them put together. It means that you are going to have cost section. You are also going to have amortization section. You are not going to have depreciation. For intangible asset, you amortize. For tangible asset, you depreciate. I'm sure you understand what I'm saying, right? Any question? Is it clear enough? Can I go ahead? Are we still together?
Yes, you
Okay.
can go ahead, sir. Thank
Thank you. So that is that for that. Then you have, why I'm taking my time to explain all of this is a lot of us feel that we know some of these things, but little things makes you get to the exam or you begin to sweat. This one, how do I treat this one? How do I treat this one now? And as you are saying, how do I treat this one? How do I treat this one? Time is going. Oh, okay. I will try to not to be fast. Okay, that's that for that. So investment property, we have also looked at it under IAS 40. Investment property, any investment property that you have, put it down there. Then financial assets, that is a non-current financial asset. Hopefully, I'm very much hopeful that we are going to look at financial instrument IFRS 9 before your exams. Why I'm delaying it is usually it comes in your exam, and I want it to be closer to your exam so that you will still be fresh with it. So I want us to finish with a publish account. After publish account, we do ratio. After ratio, we do group account, and then we'll now do IFRS 9, and then we do IAS 33 EPS. I delayed these two standard just so it will be close to your exams, and I'm hopeful that we have the time to look at that. And just in case we don't have the time to look at it, please, I'm begging you now, start looking at them to prepare yourself. If you have questions, refer to me. I will always attend to you, but we must finish the publish account. And cash flow is also under publish account now. As long as once we are done with this class, our next class we are going to look at cash flow by God's grace, and after that look at ratio, and after ratio we look at the group account. Very simple. These are things that are simple that you will see in your exams, and you are going to pass by God's grace. God will help us. So quickly let's move so that we can add some speed to what we are doing. So we also have the current asset. Under the current asset, I've told you what exactly are there, the inventories. And please take notes. Let me say this also now that I'm remembering. Your inventory, they will give you something like a trial balance. They will put inventory in the trial balance. They will now give you an additional information. They will put inventory there. Please always note that the inventory that is recognized in your statement of financial position is the closing inventory, not the opening inventory. Please take note of that. If you need to write it down, please write it down. The inventory that is recognized, that you are to pick, that you are to put down under current asset are the closing inventory. Please take note of that. Opening inventories are not allowed. And usually, your closing inventory, you will see it in usually in your additional information. If they did not put it in the trial balance. Then trade and other receivables are also there. Then please, adjustments for receivables, trade and receivable. I'm begging you, also take note. There might be need for adjustments for what we call bad debts. Bad debt. You may be asked to charge 10% of trade receivable as provisions. You may be asked. Once they tell you that, please charge accordingly. You may also be asked, or you may be told that the bad debt there is a bad debt in the trial balance. It is obvious that that bad debt will not come back again to the entity. Once you see anything that is related to that, all that you need to do is the trade receivable for that year, you remove that bad debt from it. You understand what I've just said? Let me come again. For trade and other receivables, there might be adjustments, and adjustments are for provision. Now, what is trade receivable? Trade receivable simply means the money you are expecting from your debtors, those that are owing you, the sales you made on credit. If you make sales on credit, they guarantee that those you will recoup 100% of those sales are not always there. And that is why you make provision for what we call bad debt. Just in case all the receivables will not come back, you make provisions for them. Do you understand now? And since you are making provision for it, there are tendencies that the provision you even made, part of the provision will go bad. In other words, the debtor will not pay. What if the debtor maybe absconded with your money, or the debtor fold up, or there are issues and the likes? You understand? So once there is a bad debt, and it is to be written off, you remove it from your trade receivable. It's bad debt already, and since it is bad debt, all that you need to do is to reduce your profit and then reduce your receivables. In other words, you are going to credit receivable and debit your profit or loss. That is the accounting treatment for bad debt. Please take note. I'm the one that is begging you now. Is it clear? Let's go. I'm sure it is clear now. Then you have cash and cash equivalents. You have cash, your cash at hand, your cash in bank. Then cash equivalents. Your cash equivalents like your treasury bills. Yeah, your cash equivalent. That's why they are calling it cash equivalent. Your treasury bill, you can quickly convert it to money. That's that for that. Then other current assets, like the deferred tax asset, the current deferred tax asset can also come in under this place. So that is that for that. So when you add your non-current asset with your current asset, it gives you the total asset for the financial year. That is that for that. Then you have the other aspect, which is equity and liability. I've always told you that you are going to start with equity first. And under your equity, you have the share capital, the share premium, retained earnings, revaluation surplus, other reserves, and then you have total equity. And then you also have the non-current liabilities. That's your borrowings, lease liabilities, provisions. Please take note of this provision. I'm sure we look at it. I'm sure we look at it under our IAS 36 provisions, contingent asset and contingent liability. Please, the video is also there. I'm sure you can read through and watch the videos and have the understanding. Please, it's also there. Then we have borrowings. We have borrowings, and then we have deferred tax liabilities. All of these are there under the non-current liabilities. Then you also have the current liabilities. You have the payables, that is trade payables, that is the amount that you are owing your creditor that you have to pay back. Then you have the current year tax, that's the tax liability. We look at these under IAS 12, current year tax liability, which is always in your statement of profit or loss before you determine the profit after tax. you must do tax there. So that's also part of current liability. And why are we putting it there? Because we're expected to pay it in the next financial year, that is before the June 30th of the following year after your current financial year. You are expected to pay that tax to the tax authority. And you have short-term borrowings, and then you also have lease liability, current lease liabilities, and then you have provision. Sorry, IAS 37. Sorry, please. IAS 37. IAS 36 is impairment. IAS 37 is contingent assets. Provision, contingent asset, and contingent liability. Thank you. So that is that for that. So let's look at that of equity, the format. Now, let me tell you what will always help you also in your exams when you are doing, when you are to determine the assessment of changes in equity. Please, usually whatever you have in your assessment of changes in equity will always be under your equity in statement of financial position. So whatsoever that you have, this is what I'm trying to explain to you. Whatsoever that you have in your statement of financial position under equity, usually we form the headline, all things being equal. Something might not be equal. That's why I'm saying all things being equal, we form the headlines of what you will have in your statement of changes in equity. Please take note of that. And so you have, the items: share capital, share premium, revaluation, retained earnings, other reserve, and then you have total. And then you always have what we call balance at opening. Remember, changes in equity is comparing, the changes that have occurred during the year by comparing the opening with the closing. So we know what transpires within the year. If we open with 1,000 naira of equity, or let's say share capital, for instance, at the beginning of the year, the we take out of it, of course, you are not even expected to trade your share capital. Your share capital remain constant over the years, but you can add to it. You understand? So when you are adding to it, there are likelihood that you are going to have what we call share premium. Share premium are like a gain when you a further additions to the existing shares. And so, for instance, if your current share is being traded for 1 naira per share, you understand, and you have 100,000 naira of share, 100,000 number of share, and it's been traded for 1 naira. Now, if you issue share, you know that when you are issuing share, you're also issuing to the current shareholders. You know exactly you have 100,000 current number of share or shareholders, as it were. You are now issuing, and you know that your current ordinary share is being sold for 1 naira per share. So if you are now issuing to this existing shareholder at 1 naira 20 kobo, that 20 kobo on top of it is what will give rise to additional premium. That's higher than the value of your current ordinary share. So if you are now issuing at 1 naira 20 kobo, it means that you are going to have additional 20,000. That 20,000 additional is known as the share premium. So it's like the premium, what is above the current value that you have. It's as simple as that. And so you have your opening balance, very, very important. And then the next thing that you are going to have, the first thing first that you will look at is the profit that is retained for the current year in your statement of your statement of profit or loss account. You have to check what is exactly that the profit that we have for the year. And then please always take note. They may ask you to retain, and they may be silent. If they are silent, carry the whole profit after tax and add it up to the retained earning for the year. But once they tell you that the retained earning will be apportioned, one will go for dividend, some part will go for dividend, and some part will remain. Please always adjust dividend from that profit, and whatever that is remaining is what we will take to the section under retained earnings. So what you do here is very simple. Once you have dividend for the year, always first of all bring it to your statement of changes in equity. So you after the profit that you have recognized for the year, bring the dividend for the year, you less it, and then it will also give you a net. Or you can go to your workings and do the workings. You understand? But for time constraint, we are advising you bring the profit first under retained earning. The profit for the year, bring it first. If there is dividend for the year, put it and then lend it off from the retained earning. Is that clear enough? I am sure it is clear. Any question? I hope I'm not too fast. Somebody said I'm too fast. I hope I'm not too fast. Can I go ahead? Are we still together?
Hello, sir.
Yes, go ahead.
So
Hello,
you're
sir.
very fast. You're very, very fast.
Okay, I will reduce the tempo. Please mute your mic. And if you are not okay, just call me back. You can call me back and say, sir, this explain again. I am here for you. It's why I'm serving. So you know, my mine is to make sure that you pass. Call me back. I will recap. I will rephrase, and you understand. Just raise your hand and I will call you. Yes. Okay. Ace has raised her hand.
Hello, sir.
Go ahead.
Yeah, good morning, sir.
Welcome.
Sir, please, can you repeat the explanation? The
For which
explanation
one?
on the retained earnings and dividend.
Okay. Now, for others that okay, you are still raising your hand again. Go ahead. Okay. So now, for others that may not have asked a question, standard of changes in equity. Let me just recap everything together. I measures the changes at the beginning to the end of a financial period, and I said usually, all things being equal, what will form the headline of your statement of changes in equity are always what you have under the equity section of the statement of profit or loss. So whatever you have there as the headline, usually just carry it and bring it as your headings for your statement in changes in equity. But this total must always be there at the end, at the tail end. And then the first item that comes there are the opening balances. The opening balances, you put them down. If there is nothing, you put well, I'm sure there will always be something, because usually in the trial balance you see it there. And then the next thing that you bring, the first thing that you bring after that opening balance is the profit for the year. So let's just streamline to what will help you. Bring the profit for the year under your retained earning. In other words, you are adding the profit for the year to the retained earning. But once you see that there is dividend that is paid for the year, please, there are differences between dividend paid and dividend that is proposed to be paid. If you have dividend paid, that is the one you will recognize. If they say dividend that is proposed to be paid, you are not going to recognize it. You are only going to disclose it in your notes to account. Please take note of what I've just said now. Dividend paid is different from dividend proposed to be paid. If they are proposing, it does not translate to payment. Please take note. It is only dividend that is paid that you recognize in your statement of changes in equity. Take note of what I've just said. These are little things that confuse students. But just in case you get to exam and you forgot what I've just said, just keep doing what you are doing. Only your headings alone will give you 1 or 2 marks. You understand? And if the marks is 30 marks, and you're able to put down all the headings, and you don't know what exactly again to put down there, leave it, go ahead. With that, I'm sure you can have up to 2 or 3 marks. But I will advise you that you should put something down even after putting down the headings. After all, there will always be opening balance. Or in your statement of changes in equity, opening balance will also always be there. Put it there as it is required. So I'm sure you understand what I'm saying now. So if there's dividend paid for the year, after you have recognized profit for the year, put the dividend there, but understand that you are going to less it. It will now wear a jacket in this schedule of zone of changes in equity. Is that clear enough now, Ace?
Yes, sir. Yes, sir. Thanks, sir.
All right. Okay, go ahead. GG.
Well, good morning, sir.
Good morning.
Please, I just wanted to ask a quick one. I just joined the class like a few minutes ago. I just wanted to know if this class is being recorded.
Yes.
All right, thank you, sir.
So that is that for that statement of for all of these. And then if you have revaluation surplus, why I'm doing these headings for you now, this is what IFRS 18 is looking like. They just put one small thing there, but it's still the same that you have under AS1. Now they are IFRS 18 is much more concerned with having headings to give users quality views of the financial statement. When you model everything together, the user that are laymen, they may not know what exactly you are putting down there. So they are much more concerned about the headlines that will help the users to know what exactly you have put down there, and then make judicious informed decisions. So under other comprehensive income, you have your revaluation surplus, and that's what you are going to bring down here. Once you have revaluation surplus, add it to the revaluation surplus that we have. You know that you are not bringing revaluation loss here. I'm sure you know how to treat revaluation loss now. Who can help me out? How do you treat revaluation loss if there are revaluation loss? Nobody? Let me call name. Okay, Michael, go ahead.
Oh, so I want to try. I want to try. Oh.
At this stage, don't try you. If you get it wrong, I will call you on my mark.
So, what I'm what I'm telling you is when the carry amount is less than, but
Okay, Michael, I barely can hear you. Just mute your mic. Ace, go ahead.
Okay. I'm also going to try to be taking to the comprehensive.
How will you treat it there? Debit or credit? A penny. Please go ahead.
To the
Ace, mute your mic.
is to be credited.
Okay, thank you. Mute your mic. A penny. You raised your hand. Oh, penny, sorry. Ah, people should not fall my hand, though. Go ahead.
Good afternoon, sir.
Good afternoon.
Okay, revaluation loss.
Yes.
I think it's right to be credited from the financial statement, then debited to the profit and loss. I don't know if I'm correct there.
Let me clap for Ekpeyong. Though he said he's trying. But let me say, it's not Ekpeyong, it's Opani. Let me clap for him. At least he tried and is on track. He said you are going to debit POL and then you credit the PPE. Ew, my wonderful student. Okay, Oloko, Olusegun, go ahead. Olusegun, go ahead, please. Okay, that's an assignment for all of you. I want you to submit it on the WhatsApp platform. How will you treat?
What?
Sir? How will you treat revaluation loss? If there are revaluation loss, how are you going to treat it? Okay. Okay. While we're waiting for the reconnections. Okay.
loss. So I don't really grab the explanation. It's like my network is kind of bad during that period.
Okay, so
I
let me
want you to.
recap now. When there are revaluation laws, the treatment is you debit, if it's the first time revaluation, you debit your POL and credit the PPE. But if it's the second or the subsequent one, you can, what you do is to, first of all, check if there are revaluation gain before now. And if there are revaluation gain before now, you are going to take the loss from that gain. You are going, and if the revaluation gain or surplus cannot cover the whole loss, whatever that is remaining as a balance, you take it to the statement of profit or loss. That is, you debit PPE. So that's how to do it. It's as simple as that. Is it clear enough now?
All right, sir. Thank you, sir.
Okay. So this is the format for changes in equity. I told you opening balances and then all these other items, you put them by the side. You fix them under each of the headings. And then at the end of the day, you are going to have balance as at the end of the year. And that's how to do set of changes in equity. So let's look at this question. It's an exact question that came, I think, 2023. I can't remember the diet, maybe May or November. Akamata Nigeria Limited is a manufacturing company. Can we see the question? Okay. Akamata Nigeria Limited is a manufacturing company. Okay, someone is asking a question. I should explain. What do you say I should explain again? Right of use assets and held for sale. Okay, right of use asset is treated under your statement of financial position. Please mute your mic, Moses. It's treated under the statement of financial position under the non-current asset. Moses, please mute your mic. Other persons too, please mute your mic. And then it's been we looked at it under IFRS 16. Right of use of asset is just like there is a contract between the lessee and the lessor, and we said that the lessor is the owner of the asset, the lessee is the one using it. And once a contract exists whereby the lessor hand over that asset, the qualifying asset, to the lessee for a period of time, that period by which the lessee is using that asset at that point in time, that asset automatically belongs to the lessee that is using it. Why? Because the lessee is not the one controlling the use of that asset. And if you check IFRS 16, where we treat it very well, there are certain calculations you have to do for you to arrive at the value for the right of use of asset. And we said the first item there is your lease liability. You have to determine your lease liability. Then you add your direct cost to it. And then you less your incentive from it. And you add the present value of the cost of dismantling or restoration. And that will give you the total of the right of use of assets. So whatever you get as a right of use of asset, that's what we call the initial measurement. Whatever you get, you take depreciation from it, and then the carrying amount at the end of the day, you take it to your statement of profit or loss as right of use of asset under the non-current asset. Asset held for sale is being treated under IFRS 5. And it means non-current asset that is being held for sale. In other words, there is a non-current asset, but criteria fully have been met. In other words, you have checked all the indications that you need to sell this asset. And then the non-current asset now, maybe you are no longer using it in the business or it's obsolete or whatever reason, for whatever reasons. And then the criteria like management commitment, the sales to take place and the likes have been taken care of. You now say, okay, I'm going to sell this asset. No, you will no longer refer the asset as a non-current asset. You will reclassify it as non-current asset for sale under the non-current asset. In other words, Once a non-current asset is now, having met all the criteria, is now reclassified as an asset that will be sold, you will no longer recognize it under the non-current asset, but rather you are bringing it under the current asset. And that is therefore asset held for sale IFRS 5. I'm sure Temilade Adeyemi, you understand it now. So when there is an asset held for sale in the question, you bring them, once all the criteria have been met, you take it to current asset. If there is right of use of asset, you are going to treat it under the statement of profit or loss under the non-current asset. It's as simple as that. Thank you so much, Temilade. So we are going to have an intensive class. Hopefully, we are going to shut down classes by 20th of October or before then. And then we are going to have an intensive class, just a very comprehensive one, 6-7 days. We are going to be together, and then we are going to look at everything that we have looked at from beginning to the end, just to prepare you and refresh you. I implore you to subscribe to that intensive class, and you know it will not be free like this one. It will be well detailed. Please take note of that and prepare adequately. We're informing you beforehand so that you can prepare. I think it's just for 5,000 naira for those number of period of time, and we are going to prepare very well. We are going to be solving questions, practically questions. Just take little overview and then we stroll and look at questions. So that's that for that. So let's look at this question. Akamata Nigeria Limited is a manufacturing company. It furnishes products and the lies and the lies. The trial balance of Akamata Nigeria Limited as at 31st December, March 2023 is as follows. Everything is there and you are seeing them as it were. And so you have revenue, you have, you know, like that. And then restructuring costs, interest received. And then you have a building. You have the total to be 1,071,160 like that. Then you have additional information. The property, plant, and equipment are being depreciated as follows. Building 5% per annum on straight line basis. Plant and equipment 25% per annum on reducing balance basis. Depreciation of building is considered as an administrative cost, while depreciation on plant and equipment should be treated as a cost of sales. Please take notes. On 31st March 2023, the land was revalued to 120,000 naira. Please take note. Income tax for the year is meant to be 4,880,000. You have to ignore the deferred tax. The closing inventory as at March 31st was 25.9. An inspection of the finished goods showed that a production machine has been set up incorrectly and that several production batches which had cost 250 to manufacture had wrong packaging. The goods cannot be sold in that condition but could be repacked at an additional cost of 100,000. They could then be sold for 725. The wrong packed goods were included in the closing inventory as at their cost of 250. Please take note of what I've just read. And then the 7% loan notes are 10 years loan due for repayment by 31st of March 2027. Interest on these loan notes needs to be accrued for 6 months to 31st March 2023. The restructuring cost in the trial balance represents, please, before I proceed, this 7% loan note, what is the 7%? What is that 7% called? My student, are we still together? Can you hear me?
Is the annual interest payable on the loan?
Thank you so much. What is the annual interest? What other name is for this annual interest? What is the other name for the annual interest in your profit or loss? Can you still hear me?
We can hear you, sir.
Okay. What is the other name for this annual interest? Oh God. The reason why I'm asking this question is this. You might be asked to prepare your
Finance cost.
you said? Daniel, go ahead. Finance cost. Thank you. That is the name that is being called. The other name for that annual interest is finance cost. Please take note of that. Very, very important. Finance cost. That is it. That's what I want you to note. The reason why I'm saying this is they may ask you to present your profit or loss in line with the new IFRS 18. And you know there is what we call financing category under IFRS 18. So under that financing activity, the element that you put there is a finance cost. And that is the name that is being prescribed under IFRS 18. So get used to it. You may not use the word interest, but as a professional, use the word finance cost. Thank you. Now, the next additional information is the restructuring cost in the trial balance. That's additional information 6 now. Represent the cost of a major restructuring of the company to improve competitiveness and future profitability. And then additional information 7, no fair value adjustment were necessary for the investment property. And then the last one, I guess, okay, that's it. During the year, the company issued 10 million ordinary shares for cash at 1 million at 1.20 kobo per share. The proceeds have been recorded as proceeds of share issues. Okay. Required. You are to prepare the statement of profit or loss and other comprehensive income, and statement of changes in equity for the year, as well as preparation of financial position as at 31st of March 2023. Total marks 25 marks. This is a question one. Is a question one in one of the ICANN examination. Very, very simple. If you are saying it, I'm sure you know. If I ask you to try it, I'm sure a lot of you will try it, and then there will be no issue. Please, can you still hear me?
Sir. Yes, sir.
All right. So we are required to treat to prepare the SOF statement of profit or loss, changes in equity, and the statement of financial position. So we are going to do it together. And I want you to, I don't know, please, I want you to snap, if you can snap this question so that we won't be going back and forth. Can you snap it? Are you seeing it? So if I just ask questions, it will help us to ascend quickly. Okay. I'm sure you have snapped this one. Let's go to the next section. Okay. Have you snapped it? I hope you are snapping. Are we still together, please? I barely can hear you. You are not talking. Can you hear me? Are we still together?
I hear you.
Yes, sir.
Yes, sir. Yes, sir.
All right.
Together.
I hope you've snapped this one too. I want you to snap. That's
Yes,
why I'm
sir.
taking my time for you
Yes,
to.
sir. Yes, sir.
Okay.
Yes, sir.
So that is that for that. So now let's quickly go and solve the question. Solution. Please mute your mic. Solution. Please, when is this? When is the financial year end of this account?
31st March 2023.
Okay.
Three.
Please, your heading very, very important. I've always told you. So you have items. I have notes. I told you in the last class that you must always show us the rounding off figure and then the currency, and it's in Naira, I guess. So we are rounding off this figure to thousands instead of a million, or we should do million. I will advise you, whatever they give you, use it in your exams. Thank you. So let's go. What's the first item that comes here? Are we still together?
Revenue.
Revenue.
What is revenue? What is the amount of revenue?
That's 624 500.
Please, once you are going to write any items down, the first thing that you do is to go and check if there are additional information on that item. Take note of that, okay?
Okay, sir. Okay, sir.
So, please check additional information. Do we have anything there? $624,500 is the amount. Okay. Please, let's check the additional information. I told you to snap it.
No, there's none.
There is none. Okay. So what is the next one there? What is the next item?
Cost of sales.
Cost of sales. Now check the additional information. Are there any other thing that we need to do? Are there adjustments that we need to make? Yes, additional information 1. The property plan and equipment are there. Depreciation of building are considered as physical, while depreciation on plant and equipment are to be treated as cost of sales. Is that also?
Yes, sir.
It's now. You are welcome to.
Yes, sir.
You are welcome to FR. So let's begin with our workings. Workings 1, cost of sales. So the first thing first is we're going to the balance that we're given. This balance brought forward. That's the first thing that we are going to bring here. What is this now? So what is the balance brought forward, please? This balance as a trial balance. What is the balance as a trial balance?
470,000.
470,000. We're told that we're going to have depreciation, right?
Yes, sir.
Depreciation. So we go to workings 2. Workings 2. Depreciation. So we have how many depreciation? Let's check. We have for building to be 5%, PPE to be 25% reducing balance. Okay.
Yeah.
So we have building. Are we still together?
Yes, sir.
Now let's go back to the trial balance and check. Building. Please always check if they had land and building. Land and building was added together. We were told that there is land and building, 251. But land, the cost of land is how much? 100,000. Are you seeing it? So let's determine the value of our building. Please mute your mic. You are making
It
noise
seems
there.
like I'm seeing two in there.
He said? He said what?
She said there are 2 buildings there.
Go up again. I saw land and building. I saw another building again.
Yes, there are. Well, always now, you know, another thing I need to let you know is assets. We always have a debit entry, a debit balance. Expense, we have a debit balance. Equity, liability, and income, we have credit balance in your trial balance. Take note of that. Is that taken? If you need to write it down, write it down. Income, liability, equity, we have credit balance in the trial balance. Assets as well as expenses, we have a debit entries or balances as it were. Take note of that. Land and building, one is on the debit side, one is on the credit side. Is that also?
Yes, sir.
Which one is an asset now, and which one is an expense?
Land and building is assets.
The
While
one
building
on
is expense.
the one on the debit side is an asset, right? The one on credit is
Yes, sir.
the one
Yes,
on
sir.
credit is an expense. So there is
A
depreciation.
liability.
It's depreciation. Depreciation is an expense. I mean, it's a liability. Sorry, and that's why it's on the credit side. Accumulated
Credit
depreciation.
side, yes.
Yeah, that's why it's on the credit side. Thank you.
Okay.
You can see accumulated depreciation. There is Apple building, plant, and equipment. So let's go ahead and
Yes.
let's go ahead and determine our depreciation. So we have building. We're told that the building total is how much? Land and building total is how much? Are we still
Land
together?
and building total is 251,500.
251
Then land is 1 million.
is 100. So 250, 500 minus
100,000.
100,000.
100,000.
So that will be equals
So you're
to
having 150, 500.
150.
Excuse me, sir.
Go ahead.
I'm sorry. It is 251,500.
That's not 251.
251,
But
500.
it's 250.
So this one will now be 151, 500. So our land and building will now be 151. I mean, our land is 151. Our land is 100, and the building is 151, 500.
151, 500.
Yes. And we were told that the depreciation building is 5% per annum on straight line basis. Once you see on straight line basis, you should know that you are going to charge your depreciation on costs. On cost. Is that taken? Therefore, our depreciation now for this one will now be equals to 151,500. Are we see together? Multiplied by
Yes, please.
5%.
7575. 7575.
Okay. 7575.
7,575.
You have done the calculation.
Correct.
Yes, sir.
7575.
Okay. That's that for building.
Okay, so it's depreciated for how many years?
It is 5%.
Just one.
5%. Look at it here. Please read it and understand. 5% per annum on a straight line basis.
Per annum, yeah.
Have you seen it?
Yes, sir. I've seen it.
Thank you.
Let me screenshot this thing.
Please, have you seen it?
Yes, sir. Per annum. Yes, sir. I've seen it.
Okay. Can I go ahead now? So the next one is what is it? Plant and equipment. Plant and equipment. So let's bring that one also in. Plant and equipment. And we are told it's on a reducing balance basis. So what is the cost of this asset? Cost of the plant and equipment is what?
18,600.
18?
18,600.
Okay. What is the accumulated depreciation?
Depreciation is 8,350.
10,000. So what will now be the current amount?
Current amount is 18,600 minus 8,350.
10,250.
10,250.
Okay. 10,250.
Exactly, what did you get it? 10,250.
10,
Because minus the
18,600.
accumulation.
Do you understand it now?
Yes. 18,600 minus 10,250.
The current amount is 8,250.
Wait first. Let's do it one after. You say it's 10,000 what? 10,250. 10,250. Okay. So depreciation now will be equals to
2,087.5 or 2,088.
multiply by 25%.
25%. It's 2,563.
Your balance, please.
1,563.
You said?
Sir, please.
Go ahead.
The figure is not correct now.
How?
So that current amount is not correct.
18,600 minus 10,000
is
10,350.
It's 8,000 plus.
It's 8,000.
Where did they get the current amount? The 10,250. 8,250, not 10,250. Yes.
Please. 8,250.
Yes.
Please,
It's 8,250, not 10,250.
It's 8,350. 10,350.
8,600 minus 8,350. How can you get it?
Wait now.
Which one?
The cost is 18,600. The accumulated depreciation is 8,350. So where did you get 10,000 now? This one should be 8,350.
Yes.
So it's correct now.
Yes.
It's the figure you give to me, I will put down. Oh. That's why I say you should snap. So I
Looks
won't
like
be doing.
2,563. 2,563, not 8,350. 2,563.
2,563. Thank you.
That's correct.
Okay. So that is that for that. And they said the one for plant and equipment should be taken to where? Additional
Cost of
information
sales.
should be taken to cost of
administration.
see. Why depreciation on plant and equipment should be treated as a cost of sales? Let me just take my time, and if this is all we achieve today, and you are okay, you can go to exam and deal with them there. So we have depreciation, plant and equipment. Okay, how much? 2,000.
2563.
2563. Sorry. So let's check again. Any other thing that is coming to cost of sales? I think we are done with our depreciation. Land was revalued. Okay. Income tax. The closing inventory were 25,900. An inspection of the finished goods showed that a production machine had been set up incorrectly and that several production batches, which had a cost of 250 to manufacture, at wrong packaging. The goods cannot be sold in this condition, but could be repacked at an additional cost of 100,000. They could then be sold for 275,000. The wrongly packed goods were included in the closing inventories at their cost of 250,000. And you know that for us to get our cost of sale, it is opening inventories, right? Opening inventory.
Yes.
Plus purchases minus our
closing inventory. About carrying word.
Is there carrying word in this question?
No.
There is none of such. So that is that for that. Now let's go to this. I want to check something from the question. Now, if you check this, they said after this revenue, they said cost of good manufactured. They did not say cost of sale. I'm just trying to look at this now. So they said cost of good manufactured, excluding depreciation. So please take note of this. Very, very important. So meaning that our cost of sale now that we are looking at here as a workings, we are supposed to start with opening inventory. Opening inventory. What is given to us in the trial balance? Please, someone should check for me. What do we have, please? Are we still together?
24,260.
24
260.
260. That's what we have. Now we had cost of goods to cost of goods manufactured. Then they said we should add PPE. We are going to add PPE, and then we are going to now less. We are going to less the closing inventory from here. Are we still together?
Yes, sir.
You say no.
Yes, sir, we are together.
Okay, thank you. So now we have to determine our closing inventory. So let's go to workings 3. Workings 3. Closing inventory. Now, from the question, we were told that the closing inventory. Please let me check. What do we have as our closing inventory as for the trial balance? Please let me check. What do we have?
It's 25.9
That's
million.
25,900. For our trial balance. 25,900, right? Then we were told that let's go to this additional information. Please, let's be fast. Time is fast spent. The closing inventories as at that date was 25.9. But upon inspection, they noticed that the machine has produced incorrectly and that the batch production had a cost of 250,000. This 250,000 was, if you check, they said the wrongly packed goods were included in the closing inventory at their cost of 250,000. So the first thing first that we do is to remove that 250,000 from that closing inventory. Are we still together? Less
Yes, sir. Yes, sir.
wrongly wrong cost. Wrong cost included. How much is that? 250. So you have 250 here. We are lessing it. This is what will it give to us if we less?
$25,650.
25,650. Okay, that's what we are going to have. So now, let's go back. They now said that it was wrongly included. Now let's check. We were now told that the goods cannot be sold in that condition, and so they could be repacked at an additional cost of 100,000 naira, and then they could be sold for 275 naira. Is that not what they said? So if the cost is now, the additional cost is 100,000 and they could be sold for 275 naira. When we take 100 naira from 275 naira, that will give us the actual production cost. Do we agree with what I've said? Let me take it again. We were told that because of the damages, we cannot in any way sell those items in that condition of 250,000, the manufactured cost. But we're now told that they could be repacked at an additional cost of 100,000, and then they could be sold for 275,000 naira. They could be sold, meaning if you are going to sell it, you know that cost is different from sales price. The sales price is different from the cost of production. The cost that you use to produce a pencil is different from the amount that you are selling it. You will have marked up the cost and to give you a selling price. Do you understand what I'm trying to explain now? But if we were now told that the selling price is the selling total value now, because this is not selling price, it's the total value of sales that will be realized on this particular batch product is 275, but the additional cost is 100,000. It means that If we remove 100,000 from this 275,000, then the cost of production would now be 175,000. Is it clear?
No, sir.
Sir, why are we separating them?
Which one? Let's read this content again. The closing inventory as at 31st of March were 25.9. But an inspection of the finished goods, look at it, finished goods, not, you understand now, not sales value now, the finished good, showed that a production machine had been set up incorrectly. When you set up a production machine incorrectly, it will either increase the cost of production or reduce it. That happens very well in manufacturing setup. And that several production batches, which had cost 250,000 to manufacture, this is the cost of production is 250. The initial cost of production is 250,000. Had wrong packaging. In other words, this 250,000 now is a wrong amount of cost of production. Remember, what we are trying to determine is the closing inventories. Is that also? Meaning that the closing this finished goods is the same thing as the inventory that you have in your stock. Is that also? But they are now telling us that the cost of that closing inventory, part of the cost of that closing inventory that was included, which is 250,000, is not correct. It is in our purview for us to correct it now. We are not doing a back work for us to correct that wrong amount that is classified into the closing inventory. Well, we are now told, they went further to tell us that if we are not going to repackage this item, the cost will be additional of 100,000 naira, and then the total items put together can be sold, meaning they can sell it for 275,000. If they can sell it for 275,000, what is the cost of that product? For you to determine the cost, it means we are going to, since they said there's a national cost of 100,000, we were told. You see, this question, ordinarily they are supposed to just tell us that after all the repackaging, the total cost is this also amount. But they are now making you to think logically as a profession that you have to determine exactly what will be the cost of production. You know, the cost of production is marked up to the sales value. Hope you know that. The cost of production is marked up to the sales. Take for instance now, if the cost of production is 2 naira, you can mark up 2 naira to 3 naira, and that 3 naira will now become the selling price. You understand me now? So when you remove your selling price from the cost of production, that is when you will get your profit on the product that you are selling, as it were. You understand? So for us to know exactly what is we are to determine the cost now, and that's why we are removing 100,000 from the 275, and it will give us the cost of that product that we are going to now recognize. Is it clearer now?
So what about the 250,000? Because you said which costs 250,000.
And that's what we have removed from that closing inventory. So now what we want to do is to determine the cost that will now be included, the cost of the correct batch of production that will now be included in the closing inventory.
Okay.
Yes. See, the one that is the less wrong cost included, 250. That's what we have done, Abi, to get 25,650.
Yes.
So now we are going to now add correct cost. And then the correct cost will now be 275 minus 100. Is that not so?
Yes.
Do we get it? Are we getting it clearer? Please, if you are not getting it, let me go back. I don't mind.
So I thought the 275 is what it could be sold.
Yes, that is the amount at which it could be sold, but it does not translate to the cost of that good.
Okay.
You understand?
So
That is the
it's now
that is
closing
what we call
inventory.
that's what we call what do they call it now? Realizable value. What you can realize when you are selling it. But that is not the cost of the inventory. That you have inventory now, for instance, you go to the market, you buy biscuit, you stock it, you buy it for 50 naira, you put it there. That's the cost of inventory, is that also? But that is not the sales value.
Yes.
You are not going to sell a biscuit that you buy for 50 naira. You are not going to, you buy it for 50 naira. You won't sell it for 50 naira. You are going to sell it, let's say, 55 naira. That is what they are telling us here. You understand now? The cost now is 50 naira. Let's assume it's 50 naira. I mean, the sales value is 55 naira, but the cost is 50 naira. You know that you have already added 5 naira as your profit margin on sales. So in this instance now, we were
Okay.
told, is it clear now?
So continue your explanation.
What I'm trying to explain is very, very simple. Let's go back to that thing. So these are things that waste your time in exam. Once you know that you are not getting it, just move.
Sorry, sir, can I say something,
Go
please?
ahead, please.
Yeah, so from what you're saying, what I understand is that you're saying that the price that should be stated for the closing inventory should be the cost price and not the sales price.
Not the sales
Is that
price now.
correct? Yeah, the cost price
Is
should
the
be
cost
what
price, yes, not the sales price.
for the closing inventory.
Yeah, for
Okay.
every closing inventory. It's not you. Do you get it now? Is it clear enough now? Are we still together?
But you are using good.
You
You're
said
using
what?
sales value. You're using sales value because it said they could then be sold.
They could then be sold for
I thought we're
two
supposed to use
seven.
a cost.
Wait now. They
Mm.
could then be sold for 275,000. But remember, the additional cost is 100,000. Additional cost is 100,000. Now, what is the exact cost? The exact cost. If we are going to sell for 275, what is the exact cost of repackaging? The exact cost of repackaging will be 275 minus the 100. Are you getting it now?
The repackaging cost is stated there, which is 100. The extra repackaging cost 100.
100. They say
Yes.
additional cost to repackage is 100. This additional cost is like a loss to you because you have this one now is something that you will now go and reconcile in the statement, your profit or loss, as it were, rather. You are not, because it's like you, I don't know how to put it now. It's like you are now spending like an extra, so to say. You are spending like an extra. Do you get it now?
Yes, sir. Yes, sir.
Okay. So what we are doing is just to ensure that we write down this cost, this additional cost. We are going to write it down.
Recognizing actually now. What are we recognizing actually?
We are going to recognize 175. You understand? As the cost of the repackaged batched products. That we include in our closing inventories. Please, I beg you to get it. But in case you did not get it, please go again over it. You will still understand it. So add this 175. It will give us our closing inventory. What do we have as a total there? This is, please add it. What do we have?
That's 25,825.
Okay, thank you.
25,825.
825. That is our closing inventory. We are still only on profit or loss. So You can see why I said don't ever start with question 1 in your exam. Please, always avoid question 1 because it can get you confused. It will just give you one thing that will demoralize you and destabilize you. And before you know it, you just say, these people are wicked. I didn't do anything. So we are trying to determine, we have determined our closing inventory to be 25,825. We are still under cost of sale. Yes, go ahead, please.
Okay, sir. Please, can you shift it to that where we are determining the closing inventory? There is a figure there that I didn't know how to come about it.
Okay.
Okay, this 25,650. So how do we come about it?
We less this 250 that was wrongly included, the cost that was wrongly included. We less it from the closing inventory as per trial balance to arrive at that 25,650.
900.
Yes.
So I'm not getting 25. What I'm getting is 29,250. They say 25,900 minus 250.
250.
Yeah, 25,900 minus 250.
Yes.
So I'm having
Yes, now
29.
it's 25,650.
Are we
It's correct now,
together?
25,650.
It's correct, please. Please check your calculator again. So please, let me recap again for that second, because I know some of us, we didn't understand what we just kept quiet. And these are little things that, just logically you should be able to reason it out. Now, the affected item, the cost of the affected item is 250,000 naira. The cost to repair this affected item, they said is 100,000 naira. And then the selling value, the selling price after the repack is 275,000 naira. How much will you recover? The cost. There was an initial cost of 250. You are now spending an additional of 100. The net recoverable that you can get will be that 275 minus 100, which is 175. Please take note of what I've said.
Sir, let me.
Go ahead, please.
Deducted 250 and deducted 100,000 again, right?
Yes.
And just recognize the proceed, which is 175.
175. Not proceed per se now. That is the net realizable value. The initial cost is 250, but you spend additional of 100. Is that not so?
100.
You spend
Yes.
additional of 100 to correct your error. Is that not so? Now, the net realizable value, the net realizable value or the recoverable value, what you can now recover, net recoverable value, is now that 275 minus the 100. Because you have already spent additional of 100.
What if we remove everything from that place you use 250? Like we say 250 plus 100.
See,
then go to the other side and put
another way that you can do it is another way that you can do this is you are going to recognize 275 minus 100. You are going to get one, instead of removing the 250 first from the closing inventory as per the trial balance. That's what I'm explaining now. Do you understand? Instead of removing the 250 first from that place, what you just do is you are going to get your net recoverable value, which is the 275 minus 100. You understand? We give you 175. Do you understand me now?
Yes.
Now, you now compare the recoverable value of 175 and then the cost. Then you now you remove that 175 from 250, you will get 75. If you now take the 75 from the 25,900, it will give you 25,825. We can still try it that way. Do you understand what I'm explaining?
Yes, sir.
Please, can we go ahead? I think it's just once you look at it again, you understand better. You reason it, you understand it better. Is that taking? So now let's go. What do we now have? I think there is no other adjustment on that one. So what
Yes,
do
sir.
we have?
Thank you, sir.
You said? So our cost of sale is what now? 25,260 plus 470. Yeah? Please add it up now. Our cost of sale is now what? Hello? 24,260 plus 470 plus 2563 minus 25825 is what? Are we tired?
No, we are on it. 24 to 60.
470998.
470
No, sir.
998. 470 998.
2567.
You can see what I'm saying now. Since now, we are only on cost
That's
of.
correct, sir.
We are only on cost. We have been able to determine only what is it called? Gross profit. That's what we want to determine since money. You can see. Don't always start with question 1. And if you encounter any challenge, anything that got you stuck, just keep doing what you know. The other ones, leave that one. If cost of sale you can't get it, you can just jump. Go and determine the other ones. Move, and leave it. Let the lecturer know, let the examiner know that you were trying to, but the thing was not going. So it won't destabilize you. That's that for that. So the gross profit will now be what?
153,502.
One.
624.
153,502. 502.
Okay. So that is that for that. So what is next for us now to check? Operating expense. So let's begin with distribution cost. Distribution cost. We can write it then. We have admin cost so that we can check this thing. There's no time. Admin cost. Admin cost. What again? I think there are something like restructuring there. Restructuring cost, yes. So just look at restructuring cost. So quickly, let's look at additional information. Okay. Building division should be added to distribution cost. I mean admin costs. Any other one for distribution cost? There is no one again for this. What do we have on the trial balance? Distribution cost trial balance 45,300. You carry direct and go. Distribution cost 45 300. Are we still together? Admin cost. This one will have adjustment. So workings 4. What do we have as per trial balance? Admin cost. As per trial balance, what do we have, please?
80,000.
8100.
8100. 8100. And we're told to put that we were told to add
Building.
building what? Depreciation, right? Yes. Depreciation of building to be taken to administrative cost. So let's go. Depreciation. Building. How much do we got that time? I think it's 7 something.
7575.
8,350.
Huh?
7575.
75.
75.
Is there any other adjustment to it? I don't think so. Please, what do we have total?
Eighty. 87,675.
87.
87,675.
So we take it to the admin. Is there anything that is under the construction cost?
87,675.
87. Is it 575 or 675? Reconstruction cost. Is there anything that they say again there?
Jesus.
They said during the year,
No, sir.
the reconstruction cost in the travel represent the cost of major records. So there are no adjustments there, so we just carried that. What do we have there? What's the cost? The construction cost 605. $605. Please, admin costs, we did workings there. Workings note 4. So all of these costs, these are costs. Please, man, let's see it from there. What do we have? Let's all of these from the gross profit. What do we have, please? Let's be fast. What do we have?
Having
19,922.
If you all of this from here, right?
922.
19,000.
922. 922.
922. Okay. So what's the finance cost?
Yes.
Remaining 2.
Yes. 19,922.
19,922. What is the finance cost?
No.
Let's go back to the trial balance. You people did not tell me there is interest received here. There is interest received, so let's check again.
6,000.
You people did not see
6,387.5. Can you hear me, sir?
6,000. How did you get that?
6,003.
Now let's go back to the question. There is interest received here, 6,000. There is loan notes interest paid, 3,195. Okay. This interest received, we are supposed to recognize it first as other income.
Yeah.
Let's quickly recognize.
Additional information.
I'm coming, please. Let's recognize that 6,000 other income first. Or let's just call it interest received. Is allowed. Interest received. Or interest income. Yes, interest income is not better. 6,000.
Okay.
So we have 6,000.
Where do we put down?
6,387.
No. Finance. Wait now. I just saw something
Let's
that we omitted.
let's approximate it to 388.
Yes.
Are we still together?
Yes, sir.
If you check the question, there was something I saw there now. Interest received. Interest received is an interest income, and we omitted it. We are supposed to have recognized it. So let's quickly recognize it. That's what I just did now. Now they now told us that there's a loan note interest paid of 3,195. Is that not so? Then there's an additional information. 7% loan notes are 10-year loan due payment. So what is the 7% of the loan notes? Where is loan note? That's 91,250. What's the 7% of 91,250?
That's 6,378. 388. 388.
Okay, 388, yes.
7% of what's that value again?
91.
91,250.
91,250.
250. Yes.
Okay.
Plus 6,388.
6,388.
Yes.
So, well, yes. This one will be less.
We are deducting or yes, deduction.
We are deducting.
19.
I think so.
Go ahead, please. Go ahead, please.
Yes.
So our problem before tax is what? Go ahead, please.
It's check the
For tax, 13 million 922. 13 million 922.
On that 7%.
Okay, now
7%.
yes. Now look at it. What? This additional information 5. It says 7% loan notes are 10 years due as at March 31st, 2027. Interest on this loan note needed to be accrued for 6 months to March 31st.
6 months. That's divided by 12.
It says
Please hold on.
That's
Abiodun,
7 all
Abiodun,
over
mute your
100
mic, please.
times 91. Oh, sorry.
Okay, who is asking the question now? The 7% loan notes are for 10 years repayment, right? Till March 2027. Is the interest loan note needed to be accrued for 6 months?
10-year loan due for
Yes. They now
repayment.
said it should be accrued for 6 months. We were now told in the trial balance that certain one that they paid. Where is it now? In the trial balance, we were told interest paid. Where is it? Interest paid 3,195. The simple meaning of that additional information is that the one that was paid though is for 6 months. Are we still together? Are we together?
Sir, I.
Can you hear me?
Yes, sir.
I was asking based on that statement that it says yes, loan. Thank you. Yes. Yes, together, sir. Yes, sir.
Okay. So now what I'm trying to explain
Yes,
is
sir.
what I'm trying to explain is this. I did a direct, I pick it directly, that's the value, for the finance cost for the year. But what you can as well do is this. They say loan, they know the interest I was paid during the year is 3,195. This 3,195 is for 6 months. How do I know? Because we were told that we should accrue for another 6 months in the additional information 5. We were told that we should accrue for another 6 months. Therefore, the one that was paid in the trial balance is for 6 months. But remember, we are preparing an account for a whole year. That was why I just did it directly. Assuming I want to add the one that was in the trial balance to the one of additional information, I would say arrive at the same value. We can still try it.
Okay, sir.
Let's try it and still see. We'll still arrive at the same thing. Now, the one in the trial balance that was paid, interest paid.
Yes, sir.
Interest paid is how much is it, please?
Accurately correct.
3,195 naira.
Interest paid equals to 3,195.
195.
Then the one that is to accrue for 6 months, accruing now.
3,193 or 94.
And let's calculate it now. Accruing interest.
3,193
Accruing interest
and
will
194.
Now be 7%. 7% multiplied by
3,195
multiplied by 6/12. What do you have?
3,194.
3,194. Yes, 3,194.
194. Because of approximation error now. So, but if you now add the two together, total will now be what?
Wow.
Total will be equal to what?
6,389.
6,389. Is that not what we got? 6,389. Yes. So our finance cost is what again? 6,388 is approximation differences. So since it says there was one in the trial balance and there's another one that is accruing for the, and we are preparing for a full year, they said we should we should accrue for another 6 months. It means that the one that is in the balance is for 6 months, because if you check 7% of 91 to 50, it will give you 6388. So they have only paid in advance, and then we should recognize the whole full year. That's what they are telling us by that additional information. So we have profit before tax. What is our tax for the year?
Information.
Are we still together? I told you.
That is 19,534, not 13,922.
Where are we? 13.
The profit before tax is 19,534, not 13.
It's 19,539.
19,534.
I mean 534 rather for profit before
It's
tax.
before interest. That one is before interest.
This one now.
Profit before interest and tax.
Yes, that one is 19,534.
19.
5.
534. Okay. It's correct like this.
Yes.
So now, what is the tax for the year? Please note, let me state this so that we won't waste time here. Your tax for the year are always going to be in the additional information. Please take note of that. Your tax for the year, you will always see it in the additional information. Always. Very, very important. Now, let's go. What do we have in the additional information for tax? Where is it? Additional information 3. Income tax for the year is estimated to be 4880. You have to ignore the deferred tax. So this 4880 is what you are going to carry as your tax for the year. 4880. So what will be our profit for the year?
14,654.
14. Oh, sorry. Profit after tax or for the year. No. 14. 14 what, please?
654.
54.
54.
Thank you. Now, that is this is for comprehensive income. You can call this profit before other comprehensive income or profit after tax. So now let's determine our other comprehensive income. I know I saw something like that. That was why I told you, once you begin to see in your additional information that there is a revaluation, just know that there is going to be what is it called? An OCI. Do you understand now? On March 31st, 2023, the land was revalued to 120,000. Remember, we were told in trial balance that the land is 100,000. So that means we are going to have workings 5 or working 6. This is interest. This is workings 5. Then working 6 now. Working 6 now is revaluation of land. What is the cost? Or let's use it, carrying amount, because land does not depreciate. Carrying amount
100,000.
100,000. The valued amount 120,000.
Yeah.
Is there
Where
a
do you get it?
Where do we go?
You want 20,000.
additional
Additional
information
information
too?
too.
The additional information too.
Is this a gain or a loss?
It's
Again.
a gain. Gain of 20,000.
Again. Evaluation gain.
It's okay.
Revaluation gain. Why is it
Gain.
how? Why? Because the current amount is lesser than the
It's lesser than the
recoverable
evaluation and
or
recoverable.
recoverable amount or revaluation amount. Do you understand now? Thank you. So 20,000. So this 20,000, you are going to recognize it under your OCI, and then it will also go to your revaluation revaluation reserve. Yes. So let's go. OCI. So we have revaluation surplus or gain. Revaluation gain. How much? 20,000. So our total comprehensive income will now be what? 34,654. Yes. Total comprehensive income for the year. How much? Are we tired?
No, sir.
Because me, I'm tired though. We should go ahead. So this is all about, I don't think there's any other thing there. Total comprehensive income. And I feel like we are done. There's nothing again. Are we together?
Yes, sir.
Yes, sir.
Yes, sir.
So let's look at the standard of changes in equity. You have items. From the trial balance, I think I saw share capital. I saw share capital in the trial balance. I saw share premium. And then, since there's profit for the year, there's going to be retained earnings. Please mute your mic. The valuation will be there. Valuation reserve. And then I think we are going to have total also. Yes. Total. So opening, I told you, always start with the opening balance. So your opening will be, let's check the trial balance. What are the openings in the trial balance? This center of change in security is always very, very simple. Just put it and get your mark there and move. Okay. Well, ordinary share capital of 1 naira, 100,000. That's the opening. Share premium 2150. Please just snap this one so that you just give me the figure sharp. Oh yeah, give me opening. Share capital is what?
100,000.
Mute your mic, Obiko. What's for share premium?
2,150.
150. Retain earning.
143, 385.
140.
385.
What about reserve?
15,625.
Okay, is there?
You said that better.
So what's the total, please? 15,625.
625.
Yes.
But sir, is revaluation surplus that is in the trial balance.
It doesn't matter. It's the same thing. Revaluation reserve and surplus is the same thing. You can't bring loss here. Do you understand?
Yes, sir.
Thank you. So somebody should be getting the totals while we move. So you have, we were told there were issue of shares.
258, 160.
258.
160.
160. Thank you. We were told there were issue of shares during the year.
Yes, sir.
So once there is a share issue, that's the first thing first that we will treat. Share issue.
Yes.
They said 10 million naira of shares at 1 naira 20 kobo. Please multiply. What do we have? By
Please, what are you multiplying?
10 million multiplied by 1.20. What do we have?
12 million.
12 million. So now, once there is this share issue, I was explaining the other time. If you check the tribunal, we were told that their share, what is it called? The ordinary shares how much? 1 naira each. Is that also?
Yes.
Eh?
Yes, sir.
In other words, if there is a share issue, it means they are giving additional shares to the existing shareholder. But the existing shareholders, the ordinary share is 1 naira each. So the first thing first that you are going to recognize is what is it called? That you say it's 12 million. Is it 12 million? Trying to calculate here.
Yes, sir. 12 million thousand. 12 million naira.
Okay. So if it's 12 million, it means that so what I'm trying to explain is this. Since it's 12 million, the premium on that 12 million is the 2. Since it's been sold, so the way to do it first is, since the price of their share is 1 naira, is 1 naira per ordinary share, you are going to first of all sell at 1 naira first. Then the one that is on top, that 2 naira that is on top, becomes the one that you recognize as the value. What I'm explaining is this. Premium will come as like an additional, like, when you are paying premium on insurance now, it's just something like that. As in, the value is higher, so you are recognizing that higher value as your share premium. You understand now? So the share issue now, let's do it. Let's do calculation here. Will now be, we have 100,000 first. 100,000 multiplied by 1 naira. Multiplied by 1 naira. Please.
Give us 10 million.
Give us 10 million, right?
10 million.
Yes. That 10 million, this 1 naira is the ordinary share price. You recognize it. Then, the other one is
20 kobo.
2 kobo. So now be 100,000, 100K, multiplied by 0.220 kobo. That's how much?
2 million.
2 million. So this 2 million will go to the share premium. That is the additional 2,000.
Okay.
Do you understand what I'm doing? Sure you do.
Yes, sir.
Yes,
So
sir.
the next thing that you are going to bring here, assuming there is a dividend for the year, you are going to recognize that dividend first. But in this question, there is no dividend. So since there is no dividend, the next thing you are going to bring is a profit for the year or profit after tax.
So there's dividend in the question.
Where? I didn't see it.
Ordinary dividend paid 5,000.
Dividend paid
It's
is there?
after 18 minutes. Yes. Also,
Okay.
proceeds of shared issues
Okay.
also
I've seen.
there.
Okay. I remember now. Oh yeah, let's go. Dividend. We can write under this one. It's the same thing. Dividend paid. Or let me put it the way to help you in exam. So dividend paid is how much? 5,000. So you take it to where? Retain earning. This one will go to anything dividend pay or profit for the year. They are handled under retain earning. It says how much? 5,000. So you less it. You less the 5,000. Did you see it now? 5,000. It's very, very simple.
Okay.
You said?
I mean, the 5,000, we are deducting it from the retained earning.
Yes, you are going to you say paid now, dividend paid. I was explaining it the other time before my network went. I told you, I said there are two ways you can do. You can net it off and bring the balance here as retained earning. You understand? How do you do it? Profit after tax minus dividend will give you retained earning. You can do it that way, or you just do it directly this way. But IFRS 8 they want users to know exactly what is transparent on your financial statement. You can choose to do it this way, or you do it as a workings. But let's keep doing it this way so that you can have your mark and there's no time to be doing all those workings. So profit after tax is what? What is profit after tax?
14,664.
4.
Okay. So I think that is that for that. Okay, we have a revaluation, right? Revaluation gain. You remember?
Yes.
Revaluation gain will go to revaluation reserve.
Okay.
How much is it?
20,000.
20,000.
20,000.
20,000. So then you now have organic. Then I have closing balance Yeah. What do we have? So please total all of these things. Be totaling them. Let me go back. This 100,000 here, there's nothing there. So the total here will be what? 10,000. Please, this is your total. We value it very much. 10,000. This one is 2,000. 2,000. Then this one is 5,000. Negative 5,000. 5,000. Then this one is 14. 14. Please help me be totaling this thing as I'm writing 654.
Okay, the revaluation is the reserve. 35,625. Reserve.
Yes, I'm coming 1 minute.
The total for reserve.
Wait now.
Okay, that means I will send it to you. No problem. But they'll pick the item from your showroom. They'll pick the item from your showroom.
So please mute your mic, Auntie.
But you think at least you can.
Auntie, mute your mic, go. So the closing balance
is 297,814.
297,814.
Yes, sir.
297,814. Please, the total for each balance, the total for each item is very, very important too. So what is the total for ordinary share? I think it was 110 or so.
110.
What is the total for? Huh?
For reserve.
Reserve is what?
35,625.
35,625. Auntie, please mute your mic. The total for retained earnings is what?
150,039.
150.
39.
150.
039.
039. Okay. What else again? I think that should be
It's
all.
160,039. 160,039 for retained earning. $160,039.
Which one? Retained earning?
Yes, sir.
Please check well, though. I don't want to be canceling. This is 143.85 minus 5,000 plus 14,654.
Yes, it's 150. Not 160. It's correct.
Stop.
The retained is correct.
Okay.
Premium. Share premium. 4,150. 4,150.
4,150.
Yes.
Okay. Thank you. So that's all right.
Yes, sir. The total is 299,814.
299.
814, not 297.
Is what you gave to me. Oh. So this is how to do setup of changes in equity. You can see it's very simple. It's not something that is difficult. So can we still do statement of profit or loss? Statement of financial position? I'm very exhausted.
Yes.
We started since 11. This is 2 o'clock. 3 hours.
Sorry, sir.
So
Sorry, sir.
what we do is
I just
the next class